Moving on to our 10th topic of the financial curriculum, term sheet. Term sheet. Raising capital from the right people on the right terms with the right relationships is critical to the success of any venture. Investing in private companies is very different from buying public stock. An investor can't simply sell shares until there is some event like a bankruptcy, strategic sale, or initial public offering. Investors have to worry about the operating and financial decisions entrepreneurs make that affect the value of their positions, decisions they often have little control over. For this reason, they need a different contractual relationship with the entrepreneurial ventures that's simple common stock with limited rights. Describing further the term sheet, there are multiple forms of investment that could be used when investing in a private company. The simplest is common stock. With common stock, the investor and the entrepreneur share proportionately in the value of the company. If the company is sold later for 100 million, the entrepreneur gets two-thirds and the investor gets one-third. The same is true if the company is sold for $10 million. But that last calculation reveals a problem with using common stock. What if an acquirer likes the team and offers to buy the company for 10 million the day after the venture capitalist wires the money? The venture investor will only get 3.3 million. It doesn't seem fair that the founder would get 6.6 million and the new investor would lose money. That's why venture capitalists use a convertible preferred stock. That security is structured so that the investor gets the greater of the liquidation value of the stock or the amount they would have received if they converted the preferred shares into common stock. Investors and entrepreneurs strike deals that reflects the likely path of any venture. The company will need more rounds of financing and everyone has to plan for further dilutions. The same is true of recruiting team members. Investors and entrepreneurs plan to use stock as part of the compensation package for new key hires. Every venture will make mistakes or pursue strategies that don't work. The inevitability is built into every deal. Most importantly, investors and entrepreneurs negotiate to find common grounds. There are trade offs between terms. For example, the entrepreneurs might argue for a higher price per share. The investors might agree to a higher price, but insist on participating preferred stock that gives them more of the value pie if the company is liquidated at a lower valuation. The entrepreneurs might be willing to accept that feature if they're highly optimistic about the prospects from their firm. Moving on to the final slide of the term sheet. The final terms of any deal are also driven by the market. If there are lots of venture capital firms with lots of money, then the entrepreneurs can negotiate for better terms. If the market has crashed, as it did in 2000, the options and the terms will be worse. Or if a sector is hot, like L, big, data, or cryptocurrency, terms will favor the entrepreneur. Remember that investors do this for a living. Most entrepreneurs don't have lots of experience crafting or negotiating terms of an investment. Get a lawyer. They can help enormously in finding the best set of terms, not necessarily the highest valuation. They can also help with tax planning and other highly technical tasks every early stage venture must accomplish. Stock option plan, incorporation, tax structure, intellectual property, employment agreements, and etc.